Good morning again. This is Vivek Banerjee welcoming you to the session of security analysis. Today I will discuss the technical analysis part of the security. PPTs first and market hypothesis, some portion were left, and I will take that first and then I will take the practical problems. So this is efficient market hypothesis. I have just discussed in the previous class the weak form of efficiency, the semi-strong and the strong form of efficiency. But let us first revise this again and take what these three forms are, and then take the challenges to the efficient market hypothesis. So what this efficient market hypothesis is? Efficient market hypothesis is what it means is that all available price in all available information, including the price sensitive information, is reflected in the securities prices. So it means that no investor can consistently outperform the market or consistently beat the market or can consistently predict the market. So this is the basic foundation of the efficient market hypothesis, that every information is actually reflected in the prices. There are three parts in which the efficient market hypothesis theory can be divided: weak form of efficiency, semi-strong form of efficiency, and the strong form of efficiency. Weak form of efficiency means that the prices reflect all the information in the past, means past information. On the basis of past information, the future cannot be predicted because the prices already considered the past information. That is what the efficient market hypothesis is. Weak form of efficient market hypothesis. I have taken the simple example that, for example, you see that for the last few weeks, a particular stock, you can say, decline on Monday and then goes up on Friday for the past few weeks. Next week you does the same thing. You purchases at Monday whenever the prices declines, but to your surprise you found that on Friday the prices didn't go up, it actually declined. So that is what is the simple example of weak form of efficiency, means past trends cannot be repeated continuously. And what is semi-strong form of efficiency? Semi-strong form of efficiency means the prices the prices reflect not only the past information but also the publicly available present information, such as the company has declared any dividend, the company has gave declaration announcement regarding the bonus shares, regarding any mergers and acquisition, regarding the change in the rules and regulations. So these are all semi-strong form of efficiency, and how it is affected. I have taken a simple example that you are already holding a stock of a particular company, and the company announces a merger acquisition, that it has been acquiring a big company. For this, after this merger, the scale of the company will be grown. So as soon as this the public information is available to the public, the share prices rose up, that yes, the mergers acquisition is taking place, the company's scale of operation will increase. So, but the particular investor holds securities for a longer period of time. Even if the prices increase by 25%, he is still holding it in the hope of further rise in prices. But the market corrections took place in the market, and the prices were ultimately came back to the original prices. So the public announcement of the mergers and acquisition has already been considered by the current prices. It cannot be repeated, such information. So this is what is semi-strong form of efficiency is. Now come to the strong form of efficiency. What is strong form of efficiency? Strong form of efficiency means the market not only considers the past information, the present publicly available information, as well as the private information, the price sensitive information, the insider information. I have taken example also. For example, insider is in the company and he is you can say privy of the information, or he is in knowledge of the information that the company is actually coming out with a new technology. By it can boost its production. So and this information is still in the company's domain, not in the public domain. So if an insider purchases the shares, and after the public announcement, he's hoping that the price will escalate to a large extent. It didn't happen. It increases by 5 to 6% at the most. Why would it was so? Because you can see the future, you can see the current prices already considered the future events, because some more insiders who were actually playing in the market, and that was or purchasing the shares, and that was reflected in the charts. But as you have also been seen in the recent newspapers, and that SEBI has been trying to this curb insider trading. There is insider trading regulation. So actually insider trading is very tough to happen in practical situation. But if anything such events happen, it will be reflected in the prices also. So these are three forms of efficiency: weak form of efficiency, semi-strong, and strong. Now, let us see what are the challenges to this efficient market theory. Challenges, you can say, the criticism to the efficient market theory. The first challenge is the information inadequacy. According to the basic foundation of efficient market hypothesis is that the information is freely available to the public. But actually in the practical situation, all the informations are not available to the general public, because some companies may resort to, you can say, circumventing the information. They are not passing on all the informations which are actually required by the public in order to make a sound investment decision. So there is an information adequacy in some situations. Second challenge to the efficient market theory is that the limited information processing capabilities. As you know, the human information processing capabilities are limited. It cannot absorb all the information. So even if a technical analyst is going through a thorough research, he's researching on the latest trends of the various charts, bars of the past few weeks, months, or even years, then some information may slip from his mind, even from the most, you can say, experienced of the technical analyst. And the general public, or you can say the public who are not very experienced enough in the stock market, may miss some vital informations, or you can say it may not be able to absorb all the information which has been provided to it. So limited information processing capabilities of the humans also act as a, you can say, challenge to the efficient market theory. Another challenge to the efficient market hypothesis is the irrational behavior. As we have discussed before in our session, that sometimes the investors act irrationally. For example, I am new to the, let us take a hypothetical example. I am new to the stock market, and I am investing or trading for about 6 to 7 months. For example, my neighbor is in the stock market for 3 to 4 years. He given me a tip that yes, if you invest in a particular stock of a particular company, it will go up within a few weeks. So I actually acted on his advice. So this type of behavior can be said as irrational behavior, because my, you can say, purchase of the stock of a company is not on the basis of any sound research or any sound analysis. So, and sometimes the investors act without any tips from anybody or without any research. They think that the price of a particular stock will increase. They simply purchase it. So this is irrational behavior on the part of the investors, and many investors actually resort to this type of irrational behaviors. Last challenge to this efficient market hypothesis is the monopolistic influences. As you know, or as you have gone through the various newspapers also and heard in the news channels also, that the powerful institutions actually wield great influence over the market, the monopolistic situation enjoyed by them. For example, the foreign portfolio investors, the domestic financial institutions, they have actually, you can say, controlled the market to a large extent. Not presently, initially, whenever the, you can say, foreign portfolio investors withdraw the funds from the stock market, then the stock market suddenly fell down. And they did this because of this. You can say, I will give you one example, that why the foreign portfolio investors actually sometimes resort to withdraw money. For example, the US bond yield increases. If the US bond yield increases, then the foreign portfolio investors will get more return if they invest in the bond there, because bond yield is more. They will get more return on the bonds there. So some of the foreign portfolio investors may be tempted to withdraw their holdings in the Indian stock market and invest in the US bond yields. So this may cause panic for some moment in the Indian stock market, and the prices may come down. Same is the case with domestic foreign financial institutions also. So powerful financial institutions who are big, sitting on a large amount of money, can influence the stock market. And presently it was not so as it was in the past, but still they actually influence the stock market to a certain degree. So in this situation also, the efficient market hypothesis is not satisfied. Now, I will take a few moments to discuss the moving average, and today I will take, you can say, some questions, practical questions on moving averages also. So what is basically a moving average? Technical analysts actually frequently use moving averages. So moving averages is one of the most, you can say, potent statistical, you can say, data analysis in order to investors to make a sound decision whether to purchase a particular stock or to sell it. And there are two types of actually moving averages. One is the arithmetic moving average, which is called simple moving average. Another is the exponential moving averages. This is a major difference between simple moving average and the, you can say, exponential moving average. Simple moving average or both the exponential moving average can be calculated for a 200-day, and 200-day moving average is for the long-term investors generally, where their outlook is for a long term. And 60-day moving average is for intermediate trend, medium trend. And 10-day moving average, 20-day moving average can also be calculated to detect a short-term trend. And exponential moving average. Exponential moving average is different to the simple moving average in the way that the exponential moving average gives more weight to the latest price, the current price. Therefore, exponential moving average is more suited to the short-term investors, and the simple moving average or the arithmetic moving average is more suitable to the long-term investors. And this is the basic formula of this exponential moving average: closing price of the day minus exponential moving average of previous day into exponent plus the previous day EMM. I will take one practical question also. In this way, the exponential moving average will be more clear to you. Let me take a few moments to differentiate between these two so that it can be more clear after taking some practical examples. I'm stop sharing here. Okay, so moving average. First is simple moving average or arithmetic moving average. And second one is exponential moving average. Second one is exponential moving average. The simple moving average is actually suitable for long-term investors. And this exponential moving average is basically suitable for the short-term investors. Yes. अच्छा ठीक. Okay. So this is the basic difference between simple arithmetic and the exponential moving average. Simple arithmetic average is a moving average simply suitable for the, you can say, long-term investors, and exponential is for basically the short-term investors. The base Why this is so exponentially suitable for this short-term investor? Because this it is also called EMA, exponential moving average, because the EMA is closer to the latest price, because this EMA is actually closer to the latest price. So this is the basic difference between this simple arithmetic average and exponential moving average, and both this can be calculated for a, you can say short term, you can say 20-day period, which can be called short term, and it may be for an intermediate trend, that is 20-day period, which can be called medium term, and for a 200-day moving average, which is for a long term. So moving average can be calculated for short term, medium term, as well as the long term. For short term, 10 to 20 days or even can be calculated. For medium term, 60 days moving average can be calculated, and for long term, 200-day moving average can be calculated. Okay. Now, I will try to give you some practical example of the moving average. Then I will take practical questions also. First, take some practical example in this. I am taking this Nifty, and let us go to the moving averages. For example, I will take exponential. And it can be taken for, you can say, first I will take short term, 20 days. I will give a different color to each so that you can able to differentiate. Now let us take intermediate trend. The intermediate trend say 60 days. And let us take the long term trend. That is 200 days. We will also give a different color to differentiate it. Okay, I think all these are visible to you. You can see the short-term moving average, the blue line, is actually escalating. And it actually shows that the market is on uptrend. This moving average is on the high. It means the market is on uptrend, or there is a bullish trend in the market. The intermediate trend, the intermediate moving average, that is the red one, is also on the increase, is also on the uptrend. And this, the green one, which is the long-term 200-day moving average, is also on the up. So on this, sometimes the technical analysts also use these three moving averages simultaneously in order to take a particular decision. So if this short-term moving average is more than this intermediate and the long-term moving averages, for example, 20-day moving average is more than the 60-day and 200-day moving average, then the technical analysts generally tend to buy more, because they think that yes, the trend will continue for some more time. So there is a general tendency on the part of the technical analysts to buy in such situations. And just take any other company so that you can differentiate it. Taking the Eicher Motors. Eicher Motors, you see that the moving average is somewhat different, all the three moving average. And in Nifty, all the moving averages were in the uptrend. So in this cases, the short-term moving average, long-term intermediate, and this long-term moving average is on the decline. Recently, it is showing the uptrend. So you can say moving average differentiate from company to company, and it is on the part of the technical analyst to take decision on that basis. So I am going to the PPTs again. This is on the part of my presentation. I will take the assignment now, but this is this is the email at which you can send your queries if you have any doubt, and this is the number at which you can call also. So this is in front of you. You can note it down also. Now I'm going to the assignment. Okay, fine. So if you are still any query, please ask. Otherwise, I will move to the assignment portion. Fine. So I hope this is assignment portion is visible in front of you, and I hope you got this copy of this assignment also. Even if you have not, then you can take the screenshot of this, and so that you can solve with me simultaneously. Now take the first question of this assignment. That what is the support and resistance and how it influences the investing decisions, and explain it with practical examples. Guys, this support and resistance is a very important concept of technical analysis. We have discussed it. Let us try to you can say solve it again for you for this assignment portion. So I'm stop sharing it and going to the whiteboard. So let us take support and resistance. This line, for example, the shares of a particular company, say a hypothetical example, Dabur India Limited, okay, and it is trading at, and it has a strong support at rupees 500. This is the support. It has a strong support at rupees 500. What it means? It means that whenever the market reaches or going down and reaches 500, it generally goes up. So let us say it is moving. Okay, so whenever the prices of the Dabur increases, it is coming down, and whenever it reaches 500, it tends to go up. Here it reaches 500, this portion is 500, then it goes up. Here again it is going up, down, and when again it reaches 500, it goes up. Here it again reaches 500, goes up. Here again also it reaches 500, it goes up. Here also and here also. So on 1, 2, 3, 4, 5, and 6. On 6 occasions, whenever it come to rupees 500, it again goes up. So what the technical analysts do in such situations? The technical analysts in such situations tend to buy. Why? Because they are known from the previous trend that now it has come to 500, it will not fall further. So better to purchase at this moment. So they buy at support. So support is the level at which the price is not likely to come down. Prices are not likely to come down further. Prices are not likely to come down further. Now, what about resistance? Resistance is the level at which the prices are not expected to go up further on the basis of the past trends. Now, let us say this is 750. You can say, let us take a smaller number. Let us take rupees 700. So this 700 is the resistance. 700 is the resistance. What it means that whenever the share prices goes up, it reaches 700. Whenever it reaches 700, it goes down. So here it reaches 700, it goes down. Again it reaches 700, goes down. So there are many number of occasions when it reaches 700 and it goes down. It didn't reach the 700 level for a fairly long time. 2, 3, 4, and this is 5. So in these 5 occasions, and you can say this period is for last 6 months. Let us say 6 months period, for example. So for the last 6 months, the shares of Dabur have not crossed 700. Whenever it reaches 700, it comes down. So what will be the decision in such cases from the point of view of the technical analyst? The technical analyst in such situation tend to actually sell. If they are holding the share, they will sell. Why? Because they know that it reaches 700, it will not go beyond that. Let us sell it at this level. So the technical analyst will buy at support and sell at resistance. So resistance is at the level prices are not going to go up further. So you can say resistance is the level at which the prices are not likely to go up further. So this is the basic difference between support and the resistance. So at support, the technical analysts generally tend to buy because they know that from the previous trend that the prices will not fall below that. And technical analysts at resistance will likely to sell because they know the prices will not go up from this level. So this is the basic difference between support and resistance, and this basic concept of this support and resistance. Now come to this difference between head and shoulders and inverted head and shoulders. That is the second question of your assignment. This is also a very important part in technical analysis, head and shoulders and inverted head and shoulders. And on this basis, the bullish and bearish trends are generally, you can say, anticipated. So let us understand what this head and shoulders and inverted head and shoulders is, what is their difference, and what is their significance, importance from the point of view of the technical analyst. Okay. So first I will take the head and shoulders. Let us take diagram first so that you can understand it. So this is the simple head and shoulders. This is the head. This is the head. This is shoulder. And this is shoulder. This is one head and these are two shoulders. So what it indicates, first draw a neckline. This is a neckline. So if the stock of a particular shares decline from this level, decline from this neckline, it shows a bearish trend. It shows a bearish trend. So at this level, the decision will be generally to actually sell. The decision will be to sell. Why this is so? Because you see that it is going up and come down. The prices again goes up, come down, and again goes up. But this level actually, this present high, is lower than this previous high. And when it is come lower, it is actually lower. This level is actually lower than the previous low. This current low is lower than this previous low. So, on this basis, the technical analyst can judge that there is a possibility, the chances are that the price will fall further. So, they generally conclude that it is a bearish trend, it is better to sell the shares and exit from the market. Now come to inverted head and shoulders. Let's try and draw a diagram on this basis. We can discuss. Okay, now this is one shoulder. This is another shoulder. This is the head. These are two shoulders, and it is actually showing a uptrend. How? Let us first draw a neckline. This current high is actually higher than this previous high, and again, this high actually surpasses this previous high. So this high, this current high, if surpasses or crosses this previous high, the technical analyst at this level take a decision that yes, there is a bullish trend. The chances are, the possibilities are that the prices may escalate further. The prices may goes up further. So at this level, they generally tend to buy, because this shows a bullish trend. So what is your conclusion? Your conclusion is that head and shoulders generally signify a bearish trend in which the technical analysts take the decision to sell, because in these cases the current low is lower than the previous low, and it is indicating a further downtrend. On the other hand, in case of inverted head and shoulders, it shows a bullish trend in which the technical analysts take a decision to buy, because the current high is higher than the previous high, and it shows a likely uptrend in the future. So that is what is the significance from the point of view of the technical analyst in both head and shoulders and the inverted head and shoulders. Yes, Yatin, you can explain the same with the diagram also. So it will be more understandable. All the diagrams are given in the study material, and I have explained it with in detail. So yes, while writing the theory, if you can give the diagram also, it will be better. Saira, anything you want me to repeat? Because I have repeated the portion, this head and shoulders, inverted head and shoulders, and support and resistance also. So if anything else you want me to repeat or repeat any point, then please clarify which point you want me to repeat. So Sairam, I hope it is clear to you. If anything you want me to repeat or anything you want me to explain again. Otherwise, I will move with the next question. Okay, fine. Now come to this question on, first of all, I will take the simple arithmetic average, the simple moving average, and then I will take the exponential moving average. Okay. Now, let us go through this questions very closely. You have to calculate the 5-day simple or arithmetic moving average of daily closing prices. So, trading day and the closing prices are given in front of you. Let us try to solve this question. Sairam, I am taking moving average, a practical question on this moving average. So, in this case, it will be more clear to you. So, let us solve this question. Trading day and second is closing prices. Sum of 5 most recent closing prices. Your next column will be 2 centered item total. And last one is the moving average. Okay. Now let us write this. Second, third. Then write the closing prices. Seventh day it is 26.5. On the 8th day it is again 26.5. On the 9th day it is 26. And on the 10th day it is 27. Okay, so first of all, let us calculate the sum of 5 most recent closing prices, because we are calculating the moving average for a 5-day. We are calculating a 5-day moving averages. So let us calculate this first. So it is actually 127 from 25 to 26. Now we will add this 26 to 26. That is from 2nd day to the 6th day. Okay. So 26 plus 25.5 plus 24.5 plus 26 plus 26. So it will come to 128. So it is coming to actually 128. Now let us add the sum of 5 most recent closing prices, 3rd day to 7th day. plus 26 plus 26 plus 26.5. So it will be 128.5. Now add 4th day to actually 8th day. 24.5 plus 26 plus 26 plus 26.5 plus 26.5. It is coming to 129.5. Now let us add this fifth day to 9th day. 5th day to 9th day. So 26 plus 26 plus 26.5 plus 26.5 plus 26. That's coming to 131. Now calculate the last one, the period ending day from 6 to 10. Let's add it. So 26 plus 26.5 plus 26.5 plus 26 plus 27. So it is coming to 132. Now, before calculating the moving average, we will calculate a two-centered item total. Means this 127 plus 128, then 128 plus 128.5, then 128.5 plus 129.5. Then 129.5 plus 131, and lastly 131 plus 132. Let us calculate it. First, the two centered item, we will calculate 127 plus 128. It is coming to 255. Then 128 plus 128.5. It is coming to 256.5. Then 128.5 plus 129.5. It is coming to 258. Now 129.5 plus 131. Coming to 260.5. And lastly, 131 plus 132. Okay, now calculate the moving average. So this 255 is actually for a 10-day period because we have added the total of 125, 127 and then added the total of 226, 128. So this plus this is for a 5-day, 5 most recent prices, 1 to 5 days, and this is for the total of 2 to 6 days. So this is actually 255 is for 10 days. So in order to calculate the moving average, we have to divide 255 upon 10. So 255 divided by 10, it will come to 25.5, 25.65 this will be 25.8, this will be 26.05, and this will be 26.30. So this is the moving averages. We divided all these figures by 10, 25.5, 25.65, 25.8, 26.05 and 26.30. So how we have proceeded in this question? It is a very simple question of simple moving average and or arithmetic moving average. We have to calculate the 5-day simple moving average. So we calculated the sum of 5 most recent closing prices, which is we first add the figure from 1st day to 5th of day, then 2nd day to 6th, then 3rd day to 7th, then 4th day to 8th, then 5th day to 9, and then 6th day to 10. So the total we have arrived at is this. Then we, before calculating the moving average, we calculated a two-centered item total. That is 127 plus 128. This 127 is the closing prices, sum of closing prices from 1st day to 5th of day. And this 128 is the closing prices, sum of the closing prices of 2nd day to 6th of day. So if we add both this, it will come to 255. So on, we have actually taken the two-centered item total. Then in order to arrive at the moving average, we divided this two-centered item total by divided by 10, because it is not for 5 days, it is for a 10 day. Because 127 is for 1 to 5 day and this 128 is for 2 to 6 day. That is why it is has been divided by 10 to arrive at this figure. So this is basically the moving average, 5 day moving average. Any question on this? Okay, I think one or two queries have emerged. Okay, so Mr. Harshad is asking that in Head and Shoulder we should buy as a market. We should buy as market is bearish and most likely to go up after fall. And in inverse case, we should sell as market is bullish and mostly likely go down. Harshad, actually, this is not the case because Head and Shoulders in trend, you have to see that whether this is an uptrend or this is a downtrend. You should not wait for the prices to come down in order to take a sell decision. In the Head and Shoulders, the trend is the downtrend. You have to see the present trend. Okay. You are saying that in Head and Shoulder we should buy as the market is bearish. If the market is actually started falling, in that case you should sell now. If you are already holding the shares, you should sell in that particular situation. See that. Again, see this. This is the inverted I have taken. This is the Head and Shoulders. Okay, this is the head. And these are two shoulders. Okay, this is one shoulder, shoulder 1. And this is shoulder 2, and this is the head. Now, let us understand this. The prices are, for example, here it is rupees 50, suppose. It gone from 50 to 60 within a few days, say 1 week, from 50 to 60. Then it come down from this 60 to rupees 55. Okay. Then it again goes up from 55 to say rupees 70. Then it again comes down from 70 to rupees 65. It comes down from 70 to rupees 65. Then it again goes up. Again goes up to, you can say, somewhere between 65 and 70, say 67. And then it comes down again. And when it comes down again, it reaches to 45. Okay. For example, you are holding one share of this particular company, say XYZ. You are holding a particular share in this particular company, XYZ Limited. You purchase it, or when you will, for example, you are holding this share. And you are holding this share at about, or you can say the market actually goes up, or you purchase it at 50 itself. The market is on down. You purchase it at 50 itself. Now, you hold it for some weeks, it gone up from 50 to 60. You simply does nothing. It comes down again to 55. Again goes up. So yes, the market is an uptrend because this high is actually above this previous high. It comes down from 70 to 65. You did nothing. Then it goes up. It didn't breaches this previous high. At this point also, the many technical analysts say, because they think that the market will not go up further. But you wait further. And after the 67, it slides down drastically and reaches to 45. So if you are holding a share, for example, at rupees 50, will you be, you can say, holding the shares further? You will not hold it. No? You will not hold it here. You will want to sell at 45. Once it reaches this level, once it breaches this level, rupees 50, because you have purchased the shares at 50, when it reaches this previous low, this is the previous low. Once it reaches the previous low, you want to sell it and exit from the market. You will not buy further shares because what is the reason? Because you never know that it may, when it will move beyond 45 or it may slide down further also. It may move down to 40 or even 30. So will you be still holding the shares? My question is, would you be still holding the shares? The answer is no. You want to exit the market as soon as possible once it has reached the previous low. Because the market is showing a downtrend, you may not know that the market may come further also. It may peak from 45 also, but the chances are that it may slide down further also. So the basic decision of the technical analyst in such cases is to sell the shares at this level if it has already holding it, and not to buy it unless it actually gets some bullish trend or some bullish scenario. For example, yes, you see that it's attractive, the price is trading at 45, but when it will go up from 45 or you may not know. So you have to wait for some uptrend or bullish signal in order to buy a particular share. I think we have got this point now. Now let us come to head and shoulders. I think now it is clear that why in head and shoulders scenario you should sell, because the market is on a downtrend. You want to, if you are already holding the shares, you want to exit from the market as soon as possible. Now let us take an inverted. Now inverted head and shoulders. See. Here, the head. This is the head, this is the shoulder, this is the shoulder, and this is the neckline. Now, you are observing, this is a separate company, say ABC Limited. Now you are observing this shares of ABC Limited for the past few days or past few weeks. You see that the shares of this, you can say ABC Limited, has fallen from, say, rupees 100. It was trading as rupees 100. Say it fall from rupees 100 to 50 within a matter of few weeks. Then it again picked up. It picked up and reaches at 70. Say. Again it come down and reaches this level. It reaches to about 40. But it again picked up and reaches to 80. But after that, when it slides down, it breaches the previous low. You see that the next low, this is actually, it is lower than this previous low. This 40 is previous than the, lower than the previous low of 50. Now it reaches this 40 and reaches 30. Okay. And then again, not this. It's a different scenario. Okay. Now, you are observing the, you can say, shares of this particular company, ABC, at 100. It was trading at 100, come down to 50. Again, it goes up to 70. Then again come down to 40, goes up to 80, come down to about 60. And then it goes up to 90, say. Okay. So this is the neckline. This is the neckline. This is the neckline actually. This is the neckline. So if you see that this current high is higher than this previous high of 80. So what it indicates? It indicates that the market is on a high, the market is on an uptrend, there is a bullish scenario, and the prices are likely to go up from here, not go down. So whether you will like to purchase at 90, the answer is yes. You may say that, yes, you can purchase it at 50 also because market is at lower. But you never know that it may increase further also because you see it has been declined from 50 to 40. At this situation also you cannot buy because you never know that it may fall below 40 also. Then it again reaches this level. Now this high 80 is higher than this 70. So many of the technical analysts buy at this level also, means when this high, this 80 is higher than the previous high of 70. But when it falls to 60 and goes up again to 90, then there is, you can say, substantial support, a substantial proof that the prices are on the uptrend. The prices of this particular price are on uptrend because this 90 is higher than this previous high of 80. This 80 is higher than the previous 70. So the decision in this case will be to actually buy from the point of view of the technical analyst and not sell because it is showing an uptrend. It may come down also, but chances are, the possibilities are that it may go up further. So it is better to buy at this position from the point of view of the technical analyst. Okay, so I hope this difference between this head and shoulders and inverted head and shoulders clear to you. Why in head and shoulders this shows a bearish trend and why inverted head and shoulders shows a bullish trend. Okay, Sairam, you were asking that why we doing this moving average. Sairam, moving average shows it is an indicator. It shows that the average means whether the market is on an average where the market is moving up or on an average where the market is going down. And what is the difference between the simple and exponential? Exponential is more, you can say, closer to the latest price. So generally the short-term investors generally use exponential moving average and the long-term investors generally use the simple moving average. I will share it again, this moving average portion. Let us see. Let us take the moving average of this Nifty itself. More clear to you. Nifty 50. So Nifty 50, you can see that this moving average, the average of the last, you can say 20 days. So last 20 days, the average price of last 20 days is on the upward trend, that is upward moving trend. So this is the short-term trend, 20 days moving average. This, the red one, the 60-day moving average, the average of the last 60 days price is also on the uptrend. It also shows a bullish trend. Now this is green one. This is the exponential moving average. This is also on the uptrend. Okay, so what it signifies from these three moving averages, you can easily tell that the Nifty, the market is on the uptrend. It is showing a bullish trend and it is likely to continue for some more time. Okay. So this is basically a powerful indicator, this moving average. So I hope it is clear to you. Any other queries? Otherwise, I will move further. And I hope, Arshad, your query is also been satisfactorily answered. You are convinced whatever I have explained. Okay. Now go to the next question, question number 4. And this is the question on exponential moving average. Let us go through this question first. That is, the closing values of NSE Nifty have been given 66 to 17th day of the month of January. The date are given, and it is given that on which day the Sensex was at which position. For example, on 6th of January, the Sensex was 14,522. On 7th of January, reached 14,925. Then 8th and 9th was Saturday and Sunday. You know, no trading takes place on Saturday and Sunday. Then on Monday, the market opens at 15,222 and so on. Now, what do you have to do in this question? You have to calculate the exponential moving average in Sensex during the hour period. And the previous day exponential moving average of Sensex is given. It is 15,000. And the value of exponent for 31 days EMA is also given, that is 0.062. Exponent is actually the multiplier, the weightage given to the latest prices. So this value of exponent is given 0.062, and you have to give an analysis that whether this exponential moving average is showing a uptrend or it is showing a downtrend. So let us go back to the question, try to solve this question first and then analyze. Fine. Okay, great. Sairam, Harshad. Fine, great. Now let us try to solve this question. Stop sharing it. So well, let us move on with this question. It is question number 4 of the assignment. Let us put the values first, date and Sensex. This is 6. The Sensex is 14,522. On 7th, the Sensex is 14,925. Now on 10th, the Sensex is 15,222. On 11th, it is 16,000. And on 12th, 16,400. On 13th, it is 17,000. And lastly, on 17th, it is 18,000. So I have taken the values on those days where actually the trading took place. Now the next column will be the previous EMA. That is exponential moving average of the previous date. If date is 6, then it will be the previous EMA will be the exponential moving average of the 5th of January. So previous EMA in case of is given in the question that it is 15,000. Okay. Now next column will be you have to first deduct this Sensex price, closing prices minus the previous EMA. This Sensex is actually the closing price of the Sensex. So this is 1, this is 2, next column this is 3, and 3 will be this 1 minus 2, and whatever figure it is arrived at means the closing price minus this previous exponential moving average will be multiplied by the exponent. So it will be, fourth column will be this 3 multiplied by 0.062. How this 0.062 arrived at, it is given in the question. This is the exponent for 31 days. 5. Now fifth column will be, then this will be added to this previous EMA. So it will be 2 plus 4. Now let us solve this, then it will be more clear to you. First of all, we have to begin with the closing price minus the previous EMA. First you have to calculate this. So 14,522 minus 15,000, it is 478. It is minus 478. This figure will be minus 14,522 minus 15,000 minus 478. This minus 478 will be multiplied by the exponent which is given to you, 0.062. So it is coming to minus 29.636. And whatever arrived at means closing price minus EMA multiplied by the exponent plus the previous day EMA. Okay. So it is the formula which has been given in your study material also. So we add this 15,000 plus 29.636. Since this figure is negative, it will be less than 15,000. It is coming to 14,970.364. Now on 7th of January, the EMA, previous EMA will be this. The EMA we have calculated on this 6th of January. So previous EMA we will just copy it, 14,970.364, and we deduct it with this closing price figure, closing price of 7th of January. $45.364. This figure will also be negative. We multiply this figure by the exponent 0.062. This is 2.812. And then it will be, this figure will be added to this EMA. So just coming to 14,967.55. So this is the EMA for the, you can say 7th of January, 967, 14,967.55. Now we have to calculate the EMA for the 10th of January. For 10th of January, previous EMA will be this. So simply copy this. 14,967.55. Then we have to deduct this closing price minus EMA. Is coming to 254.45. This figure is positive. This will be multiplied by exponent again. 254.45 multiplied by 0.062. Is coming to 15.78. This 15.78 will be added to this EMA. So it is coming to 14,983.32. 14,983.33 you can say. So this is the EMA for the 10th of January. So for 11th of January EMA, we have to calculate. First of all, we will copy this previous EMA, that is EMA of the 10th of January. So let us write it down. 133. Then deduct this closing price minus the previous day EMA. Okay. And then this figure will be multiplied by the exponent into 0.062. It's coming to 63.03. 63.03 will then be added to this previous day EMA. Is coming to 15,046.36. 15,046.36. So we have to now calculate the EMA for the 12th of January. First, let us copy the previous day EMA of the 11th of January. 15,046.36. Deduct this closing price minus the previous day EMA. It's coming to 1353.64. And this figure will then be multiplied by the exponent 0.062. It's coming to about 83.925. And 83.925 will be added to this figure now. So it is coming to about 15,130.28. 15,130.28. Okay, just give me a second, please. Okay. So now we have to calculate the EMA for 13th of January. First, bring the EMA of the previous day, that is of 12th of January. 15,130.28, and then deduct this closing price minus previous day EMA. This is 1869.71. And it will be then multiplied by the exponent 0.062. This is 115 point. This is 115.92. Then this figure will be added to this previous day EMA. Is coming to about 15,246.20. 15,246.20. Now we have to calculate the EMA for the 17th of January. First, copy the EMA, previous day EMA, that is of 13th January, which is 15,246.20. And closing price minus the previous day EMA. Just coming to 2753 point, you can say write it down as 0.3879 or you can say 80, and then multiply this figure with the exponent, that is 0.062. So 170.74. Then add this 170.14 with the previous day EMA. So it is actually coming to 15,416.94. So this is the EMA which is coming on 17th of this January. So also confirm at your end also this calculation 1542. All these EMA calculations are coming or not. I hope it is correct. So in this question, how we have proceeded? What is the basic formula of the exponential moving average? The basic formula of this exponential moving average, which I have discussed during the my presentation also, that basically it is the closing price. It is the closing price minus the previous day EMA. And this figure, whatever arrived at, is generally multiplied by the exponent. And then this entire portion is added to the previous day EMA. Added to the previous day EMA. So this way has been calculated. As you have seen that how we have proceeded. We first deduct the closing price minus EMA, closing price minus previous day EMA. Previous day EMA is given in the question 15,000. This is what is arrived at, and then it is multiplied. This portion minus 478 is then multiplied by the exponent. Multiplied by the exponent which is given in the question 1062. Whatever arrived at this figure is here to here. This portion is actually 29.636, and then it will be added to the previous day EMA. Added to the previous day EMA. So this is your final exponential moving average is 14,970.364. In the same way, all these moving averages, exponential moving average of all the days are calculated on the basis of this formula. So if any question arises in your mind in case of this exponential moving average, please ask. Okay, I think great. 15,416.94 final. So I hope it is clear to you, this exponential moving average and the simple moving average, the calculation part. Any question, guys? Okay, fine. Shall I proceed further? Next question will be on this. Okay, Simon, please check at your end because some of the guys have actually quoted the correct answer. 15,416.94 is coming. So, if at any portion you are finding a difficulty, please ask. But you have to just clarify the portion which you are actually finding difficulty. Okay. Now, this is the fifth question. And this fifth question is on the basis of statistical and it is a bit slightly complicated. So I will try to go through this question step by step. In this question, the date and the index value is actually given. If you see, closing date and index value is given. Now, in this question, you are required to test the weak form of efficient market hypothesis by applying the run test at 5% and the 10% level of significance. And following values are used. The value of T at 5% is 2.01 at 18 degrees of freedom, and value of T at 10% is about 1.734 at 18 degrees of freedom. Okay. So let us try to solve this question. I will write down this figure first. Try to, and after that I will take about a 10 minutes break. And during that break, just try to understand what this question is trying to say. So I will just write down the figures first so that after that the calculation aspect will be easier. So I will write it down first and then I will take a brief break. Stop sharing it now. Okay, now come to this question number 5. Assignment of question number 5. And in this case, the date, closing and index value is given. Take from this itself so that most of this is covered. Date closing, and second column is the index value. Second is the index value. Okay, so 110.07, it is 2800. Then 310.07 is 2780. Then 4th of October, it is 2795. Then 5th of October, it is 2830. Then 8th of October, it is 2760. Then 9th of October, it is 2790. Then 10th of October, is 2880. Then 11th of October, it is 2960. Then 12th of October, the index value is 2990. Then 15th of October, the index value is 3200. Then on 16th of October, the index value is 3300. Then on 17th of October, the index value is 3450. Then 19th of October, the index value is 3360. Then 22 of October, the index value is 3290. Then 23 of October, it is 3360. Then 24th of October, it is 3340. And 25th of October, it is 3290. On 29th of October, it is 3240. On 30th of October, it is 3140. And on 29, 25, 29, 30 and 31 of 31st October. On 31st October is actually 3260. On 31st of October, it is 3260. So I have noted down all the values, that is the closing date on which this value of closing date and the value of Sensex. From this, we will try to solve this question on run test. So on this, I am taking a brief break about 10 minutes. So let us get back at about 8:40 and then we will solve this question. Okay, so shall I proceed with this question? I was discussing here this question. And what was this question about? This is the closing value market index for the month of October 2007 is given, that is closing date is given and index value is given, which have already this mark it on the whiteboard. And what has been asked in this question, you have to give a run test at this particular two levels of significance. Now, let us solve this question and try to understand that what this question wants, what you have to actually do in this particular question. In question number 5, the closing date and the index value is given to you. First of all, how will you proceed? First of all, let us calculate that, or let us find out that whether the market is uptrend or whether the market is in the downtrend. That is, whether the index is going up or whether the index is going down. So how will you find that? To compare it with the previous figure. For example, on 1st of October 2007, the index value is 2800. And on 3rd of October, it has come down to 2780. So whenever it is coming down from the previous day figure, then you shall give a negative sign. And whenever this is increasing, for example, from 3rd of October to 4th of October, the Sensex is increasing from 2780 to 2795. Then you give a plus figure. So uptrend, you give a plus figure. For downtrend, you give a negative figure. So let us calculate this first. Now from 1 to 3rd, it has been decreasing. So a minus sign. And from third to fourth, increasing a plus sign. 4 to 5, again increasing a plus sign. 5 to 8, decreasing a minus sign. 8 to 9, increasing plus sign. From 9 to 10, again increasing plus sign. From 10 to 11, again increasing plus sign. From 11 to 12, again increasing plus sign. From 12 to 15, again increasing plus sign. And 15 to 16, again increasing plus sign. Then 16 to 17, again increasing a plus sign. And from 17 to 19, it actually decreases from 3240 to 3360. Then you put a negative sign here. You put a negative sign. And then from 19 to 22, again decreasing. Then 22 to 23, again increasing. From 23 to 24, again decreasing. From 24 to 25, again decreasing. From 25 to 29, again decreasing. From 29 to 30th, again decreasing. And lastly, from 30th October to 31st October, it is showing an uptrend. So, increasing a plus sign. Now let us find out the number of positive signs and the number of negative signs. Means number of times the stock market or the index has gone up and the number of times when the index has gone down. So number of positives which is actually shown by N1 is actually, let us find out the number of positives first. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So number of positives are 11 and the number of negative signs which is denoted by N2. Negative signs are 1, 2, 3, 4, 5, 6, 7 and 8. The number of negative signs are 8. Now we have seen the number of times the stock market has moved upward. During the particular month of October is 11 times it has moved upward and 8 times it has moved downwards. Now we will see the number of runs. Runs means the number of times the market has changed directions. Run means the number of times the market has changed directions. Means whether by way of uptrend or whether by way of downtrend. Let us see first the number of directions. Here the market has changed direction for the first time in the month of October, negative. So we will mark it as 1. Then again the direction changes, positive. And this change in this uptrend continues for 2 days. So next changing direction we mark it as 2. Again from 8th of October the direction of market changes negative. This we will mark it as 3. Then again from 9th of October the market changes, it goes on uptrend and it continues for an uptrend for a few days. Means 9th of October to about 16th of October, it is on an uptrend. So this portion we will mark it as 4. Okay. Now from 17th of October it again come down here. 17th and 22, it is on a downtrend. So we will mark it as, this is 5th time the market has changed direction. Then it against a positive figure, so we'll mark it as 6. Then again market goes down for about next 4 days. So this change of direction continues for about 4 days. You mark it as 7. In 7th time the market has changed direction. And lastly, the positive figure, we will mark it as 8. So this time the market has actually changed direction. So what is the number of, this will be the number of runs. So number of runs will be, number of runs which will be denoted by R is actually 8. Runs is 8, or the number of times the market has actually changed direction. That is the 8 number of times. So up to this, I hope it is clear. So how we have proceeded till now? We first of all find out whether the market is on the uptrend or the market is on downtrend. For uptrend, we give a plus sign, positive sign. For downtrend, we show a negative sign, that is a minus sign. So we see that the number of positives, the number of uptrend during the month of October is 11. The number of downtrend, which is shown by a negative figure, N2, is actually 8. The positive figure we show by N1 and the negative figure we show by N2. And then we find out the number of the runs, means the number of times the market has changed direction. So market has changed direction, we have found out that it has 8 times it has changed directions. Now we have calculated the number of runs. Now this number of runs, whether it denotes an efficient market or whether it denotes an inefficient market. We have discussed that when the market is inefficient, it can be predicted. The market is efficient, it means it cannot be predicted. Weak form of market efficiency in this question we have to find out, means on the basis of past prices, future cannot be predicted. So what is the weak form of efficient market hypothesis? On the basis of the past trend, the future cannot be predicted. Means the market is efficient. When the market will be inefficient, when it cannot be predicted. So let us take an example that when the market can be predicted. So market is efficient. Sorry, market is inefficient when it can be predicted. It can be predicted. Now let us take an example and take 2 scenarios. For example, the market goes like this, plus, means it's showing a continuous uptrend for 4 years. Then it comes to minus, downtrend for 4 days, again uptrend for 4 days, plus, and then again a downtrend for 4 days, minus. So in this case, what is the number of change in the direction, or number of runs? It is 1, 2, 3, and 4. So number of runs is 4. So is this a efficient market or inefficient market? Can the market be predicted in this scenario? The answer is yes. How? See, as an investor, if he technical analyst observes closely the trend, he sees there is a plus sign. Whenever the market goes up, it goes up for next 4 days. Whenever the market comes down, it comes down for next 4 days. Again, when it goes up for next 4 days. And when again it comes down by next 4 days. So whenever the market shows a plus sign, uptrend, he will purchase it. Whenever it shows the first negative sign, he will sell it, because he knows that the price will come down for the next 3 days. Again, when the market goes up, he will purchase it and hold for next 4 days. First sign of a negative, he will sell it, because he knows that the market will come down further during the next 3 days. So this market can be predicted. So it is an inefficient market. So we can say if the number of runs is too small, that is, the change in direction in the stock market is too less, then the market can be predicted, the market can be inefficient. Now, if the number of runs are more or change in directions are more, can then the market be inefficient or efficient? Let us find out. Let us see. The first date is plus, then minus, plus, minus, plus, minus, minus, plus, minus, plus, minus, plus, minus. This is the trend. Now, as an investor, what is the change in direction? 1, then again negative. 5, 6, 7, 8, 10, 11, 12. So in this case, the number of runs are is 12. So that this is change of direction is very frequent. Whenever, for example, day 1 the market goes up, then again day 2 it goes down. Again on day 3 it goes up, and on day 4 it goes down. So can the investor predict on the basis of these trends? The answer is yes. How? Because the first day when it shows an uptrend, he will hold it and sell it on the next day because he knows that the market will move up further. And again on the next day it goes up, it purchases, and the next day he sells. Again on the third day, again on the fifth day, he will purchase, and on the next day it will sell it. So this trend continues. So what it summarizes, what it tells that if the number of runs are too large, too frequent, or the change in direction in the stock market, whether by way of uptrend or whether by way of downtrend, the market can be predicted. The market is then inefficient. But we have to find out the market is efficient or not. We have to test the efficiency. So whether this aid is efficient or not, we have to test. But if the runs are too small, the market is inefficient. If the runs are too large, the market is inefficient. So what should be the runs? The runs of the change in direction should be average. It should be average, means somewhere between this too less frequency and too much frequency. So first of all, for this purpose, we have to calculate the average in order to proceed to calculate the run test. I will rub it here because the question solution is long. I hope this portion is clear to you. Up to this portion, any queries? Up to this portion. I hope we are good to go. Fine. Now, let us find the average first. Average run. R is denoted by run, and this is the mu. That is, mu is the average or the mean. So, average is 2 n1 n2 upon n1 plus n2 plus 1. So, it will be 2 n1 n2 upon n1 plus n2 plus 1. This is the formula of the average. So let us find out the average. 2 into n1. n1 is 11, n2 is 8. n1 plus n2, 11 plus 8 plus 1. So let us calculate this and find the average first. So average is 10.26. The average is 10.26. But in practical situation, this exact average is sometimes hard to come by. So a certain amount of deviation, that is standard deviation from the mean, is required. In practicality, exact average is difficult to come. Therefore, standard deviation from mean is calculated. For this purpose, we have to calculate the standard deviation or not, in order to know how much deviation from mean is allowed. So let us calculate the standard deviation. So the formula of the standard deviation is 2 n1 n2 multiplied by 2 n1 n2 minus n1 minus n2 divided by n1 plus n2 square n1 plus n2 square into n1 plus n2 minus 1. This is basically the formula of the standard deviation. So let us put the figures into this formula. N1, N2. So 2 into N1 is 11 and the N2 is 8. So 2 into 11 into 8. Then 2 into 11 into 8 minus N1 minus N2 means minus 11 minus 8. 2 into 11 into 8 minus 11 minus 8. Now, calculate the denominator n1 plus n2 square, 11 plus 8 square, multiplied by n1 plus n2 minus 1 means 11 plus 8 minus 1. Okay. Let us calculate it. So this is coming to this portion, 2 into 11 into 8 is coming to 176 and 2 into 11 into 8 minus 11 minus 8 is coming to 157. Also check at your end also. 11 plus 8 square means 19 square, 361 multiplied by 11 plus 8 minus 1, that is 18. So it will be 176 multiplied by 157, 27,632 divided by 361 multiplied by 18. It's coming to 6498. 6498 under root. So let us find out this standard deviation now. $27,632 divided by 6498. It is coming to 2.06. 2.06. This is the standard deviation, 2.06. So also check at your end. Fine. Okay, Yatin is asking that if the market is predicted, then how it is inefficient. Market is inefficient. It means that market can be easily predicted. Means there is no use of thorough research and analysis. If you go through the price changes, the price has been increasing, you purchase it, and whenever it shows a downtrend, you selling it. That is why it is called inefficient. You can say it is a layman, a common man invested or trade in the stock market. So it cannot be considered as an efficient market if the market can be easily predicted. But actually, practically, what happens then? Can the market be easily predicted? The answer is no, because market does not behave in that way. That is continue for some days, again continue downtrend some days. It will show this trend for some period, but then it will change direction. It will move up for 2 days, go down for 3 days, and it may again move up for next 2-3 weeks. Then it will go down for 3-4 days, again then move up. So market behave this way. frequency is either too less or too more, and it is generally the frequency on an average, neither too less or neither too more on a long term, if you see that. So in this case, if it is very easy to predict the market, then it will be considered as an inefficient market. The market is inefficient. Whereas practically, as I've discussed, that you can say it is almost impossible to predict the market. So the technical analysts generally follow the rule: let us move with the market. Let us move with the market with the help of the whatever price trend the situation is showing. So if the market can be easily predicted, so it is actually inefficient. Okay. So now we have calculated the average. We have calculated the standard deviation. Now standard deviation is calculated. The deviation of 2.06 is allowed. It is still very less, because we see that if the number of runs or the number of, you can say, the change in direction in the market is too less, then the market in such situation will also be inefficient. So how to judge the efficiency? We have to set a certain level of lower limit and upper limit in order to judge this efficiency. So we calculate the lower limit and upper limit also from this case. I am rubbing it because this solution, I hope this portion is clear to you, because I have repeated it also. So I am rubbing this portion only. So up till now, how we have proceeded? First of all, you can say the closing date and the index value was given. On the basis of the closing, we find out that whether the market is uptrend or whether the market is on a downtrend. For every uptrend, we show a plus sign. For every downtrend, we show a negative sign, right? We found out for the last 31 days, the number of positives, and we show it by N1 is 11. Means the 11 number of days, the market is on a uptrend. And then we calculated the number of negative, means when the market is on a downtrend, which is denoted by N2, which is actually 8. Then we calculated the number of runs, means the number of times actually the stock market has changed direction, which is actually 8. So we also found out that if the number of runs is too large or if the number of runs is too less, then the market can be easily predicted. If the market is easily predicted, it is not efficient, it is inefficient. The market should be actually, in practicality, market is efficient, means market cannot be easily predicted. In fact, the market cannot be predicted 100%. It is almost impossible. So for this purpose, what should be the, we can say, what should be the number of runs, or what should be the, we can say, the number of change in directions. So in order to call the market as efficient, weak form of efficiency, it should be an average, means the frequency should not be too much, or frequency should not be too less. For this purpose, we calculated the average, mu. The average comes to 10.26. Now, this average is actually difficult to come by in practical situation. So we calculated the standard deviation, means certain amount of deviation from mean is allowed. So we calculated the standard deviation. The standard deviation comes to 2.06. The deviation is of 2.06 from the 8 is slightly on the lower side, because we have seen that if the number of runs is too low, then also the market cannot be considered as inefficient. In this question, we have to test the efficiency, not inefficiency. Therefore, certain lower limit and upper limit for this average should be allowed. What should be the lower limit and what should be the upper limit for this average? Let us find out. It is given in the question that you are required to test the weak form of efficient market hypothesis by applying the run test at 5% and 10% level of significance. And the following values can be used, means value of T at 5% at 18 degrees of freedom and value of T at 10% at 1.74 at 18 degrees of freedom. So we have to test this at 5% and 10% level of significance. This is basically a statistical portion. So I will not get into the details. My purpose is to just explain the concept. So let us solve this and try to just you can say grasp the concept in this case. So we have to test at 5% level of efficiency, at the level of you can say significance, and 10% level of significance. So first of all, test at 5%. Here, yes, Sairam, I will do that. After this average run, 10.26, I have written that in the actually the practical situation, exact average is difficult to come. Therefore, certain deviation from the mean is allowed. For this purpose, the standard deviation from mean is calculated. So this is the standard deviation, 2.06. Average is 10.26 and standard deviation we have calculated 2.06. Now calculate the lower limit and upper limit for the 5% level of significance. Why we calculate the lower limit and upper limit? Because the standard deviation, from calculating standard deviation, we found that the number of runs will be lower. If the number of runs is too low, then it will also show the inefficiency. In order to test the efficiency, certain aspect of lower limit, means certain range from this average should be allowed. Let us calculate this L1 lower limit and upper limit, then this aspect will be more clear to you. Now you have to test the run, do the run test, means the test of the change in direction. Run test at 5% level of significance. So run test at 5% level of significance. First calculate the lower limit. First calculate this lower limit. Lower limit is equal to, the formula of lower limit is mu, that is the average, minus t into the standard deviation. Mu minus t into standard deviation. This is the formula of the lower limit. Mu, this is average, we have calculated 10.26. This standard deviation we have also calculated 2.06. And what is this t? T is also called the t distribution. This t distribution is given in your question. That is, value of t at 5% level of significance is 2.101. 2.101 is the value of t. Now let us put the values into the formula. Average 10.26 minus t, that is 2.101 into standard deviation, we know 2.06. So let us calculate it. So lower limit is coming at 5.93. This is coming to 5.93. Now calculate the upper limit. Now calculate the upper limit. Upper limit formula is mu plus t into standard deviation. Mu, that is the average, plus t into standard deviation. Mu, the average you know, 10.26 plus the value of t is given to you into the question, 2.101 multiplied by the standard deviation. Standard deviation is 2.06. Now let us calculate this. It is coming to 14.59. It's coming to 14.59, the upper limit. Now, whether this number of runs we have arrived at is within this lower limit or upper limit or not. If it is within the lower limit and the upper limit, the market will be considered as efficient. Means it has weak form of efficient market hypothesis. Now, this is the average, 10.26. 10.26 is the average, and the lower limit is 14 this lower limit is 5.93, and this upper limit is 14.59. So whether this 8 we have calculated the number of runs is within this lower range and upper range, means 8, the number of runs should not be less than 5.93 and should not be more than 14.5. So we can arrive at the conclusion that since this 8, the number of runs is within this lower limit and upper limit, the market is efficient at 5% level of significance. The market is efficient. The market is efficient. It satisfies the weak form of efficiency. It satisfies the weak form of capital market efficiency. Now, this run test at 5%, we came to the conclusion that the particular market is efficiency. Now, we have to run test at 10% level of efficiency. Ten percent level of significance. The formula is same. First, calculate the lower limit. Lower limit, what is the formula? Mu plus T into standard deviation. Mu we have calculated 10.26 plus T is given at 10%, the T is 1.734. The T distribution is 1.734 multiplied by the standard deviation 2.06. So 1 point, it will be 734 multiplied by it will be negative this lower limit. So it is coming to about 4.06 or okay, it is now coming to 6.69. 6.69. So 6.69 is the calculated the lower limit at 10% level of significance. Now we have to calculate the upper limit. Let us rub this initial portion because now we are familiar with it. Just rubbing this initial portion only. Now calculate the upper limit. Upper limit formula mu plus T into standard deviation. Mu is given 10.26 plus T. The value is given 1.734 multiplied by the standard deviation 2.06. So let us calculate this upper limit. 10.26 the average plus 1.734 T multiplied by the standard deviation. Let us calculate it. So it is calculated coming at about 13.83. It's coming at about 13 point. This portion is 7. This is coming at 13.83. This is actually the upper limit. So we can say that the market is actually efficient because this 8, the number of runs is within this lower limit 6.69 and this upper limit, that is 13.83. Okay. So if we can draw it here also, that this is, if you find it the average upper limit at this 10% level of significance, you see that the average is 10.26 and the lower limit is 6.69 and the upper limit is 13.83. This is for the 10% level of significance. That 10.26 is the average. This is the lower limit, 6.69 we have calculated, and this is upper limit, 13.83 we have calculated here. So we have to test at 10% level of significance that this 8, the number of runs, is within this upper and lower limit. Means it should not be less than 6.69 and it should not be more than 13.83. We find out that this run is within this range, between 6.69 the lower limit and 13.83 the lower limit and the upper limit of this average. So we can say that this also satisfies the weak form of capital market efficiency. So run test at this % of level of significance, we came to the conclusion that this number of runs, that is the change in direction in the stock market, that is 8 in a particular month, in the month of October, is actually satisfying the level of weak form of capital market efficiency. And we have came to this conclusion by doing the run test at both the 5% level of significance and the 8% level of significance. So in this way, how we have we have proceeded in this question. Any queries in regard to that? Because some queries may come in regard to this. Any portion you are not able to understand the calculation aspect, because I am not going to statistics too much, but the conceptual aspect, anything which you are not able to understand, please ask. So, do you want me to repeat the solutions again? I will repeat it again for you. This solution. I hope it is clear to you now, but I will again repeat it how we have proceeded in this entire question. In the question, it is given to you the closing date and the index value. First of all, we proceeded by calculating whether the market is on the uptrend or whether the market is on the downtrend. We show the uptrend by way of plus sign and the downtrend by way of negative sign. We have come to the conclusion that in the month of October 2007, the number of uptrend is 11, that is which we denoted by N1, and the number of downtrends, which we denoted as N2, is 8. Now, after that, we calculated the number of runs. Number of runs means number of the change in direction in the stock market, whether by way of uptrend or downtrend. You see that the number of runs are 8. Now, we have to judge that whether this 8 satisfies the efficiency of the market, whether this number of runs 8 is and signifies efficient market or inefficient market. Then we see that when the market can be considered inefficient. The market can be considered inefficient when it can be predicted. If the market can be predicted easily, then there is no use of such technical analysis. So in practical situation, the market cannot be predicted. So the market in actuality is an efficient market. So we see that if the number of runs is too less, or the number of change in direction in the stock market, whether by the way of uptrend or a downtrend, is low, then also the market is inefficient because the market can be predicted in such situation. As we've seen in the example that 4 runs were coming. Again, if the change in direction or the change in trend, that the number of runs are too large or too frequent, then also the market can be predicted. The market is inefficient in such cases. So when the market can be considered as efficient, the market can be considered as efficient when it is an average market. When it is the market price moves on an average basis, that is the frequency, the number of runs or the change in direction is neither too less nor too much. So what it should be? For this purpose, we first of all calculated the average by this formula. 2n1 upon 2n1 n2 upon n plus 1, n plus 1 plus n2 plus 1. The average came to 10.26. But this average in practical situation, actually exact average is difficult to count. So as we see in statistics, we have done that standard deviation is actually calculated from the mean. So that certain amount of deviation is allowed. So standard deviation is calculated by this formula. Standard deviation come to 2.06. Now this 2.06 from 8, that is the number of runs, is still the number of runs can be considered as too less. So if the number of runs are too less, then we see that the market is inefficient. Here we have to judge the efficiency. So a certain amount of lower limit and upper limit should be set in relation to the average. So how such lower limit and upper limit is calculated? Two situations are given in the question. 5% level of significance and 10% level of significance. So at 5% level of significance, lower limit is calculated. At 5% level of significance, the upper limit is calculated. Lower limit is calculated by this formula, mu average minus t into standard deviation. T is T distribution, which is given in the question at 5% level of significance, which is 2.101. So we put the figures into the formula. The lower level limit is arrived at 5.93. Then we calculate. Upper limit is calculated as mu plus T into standard deviation. T is given 2.101. We put the figures into the formula and upper limit was arrived at 14.59. The upper limit is actually arrived at, that is 14.59. So this average, this number of test runs should be within this lower limit and upper limit in order to satisfy the test of efficiency. Since this number of runs 8 is neither below the lower limit of 6.69 nor above the upper limit of 13.83, it satisfies the weak form of efficient market hypothesis. So first level is satisfied. Now we do the run test at 10% level of significance. We calculate the upper lower limit 6.69 and we also calculated the upper limit. Then the conclusion was same, that this number of runs 8 is not below 6.69 and not above this 13.83, that is the upper limit. So we can say that at 10% level of significance also the number of runs 8 is satisfies the efficiency, or it shows that the market is a weak form of capital market, weak form of efficient market. Okay. So we have done this question like this, proceeded in a sequential manner, and I hope it is understood to you. Anything which you are not able to understand, you can write to us also. So this is what about the run test question. Okay, so shall I proceed? Fine. So this is what about a session on technical analysis. I will, since this is large, I will take a few minutes, some 5 to 10 minutes to revise the entire portion. Okay. So let us begin, and I will use the PPTs again so that you can recapitulate it, or you can recall it instantly. So I'm doing a quick of whatever I have taught during this technical analysis session. Fine. So my session began by telling what technical analysis is. So technical analysis is nothing but basically the price movement. It is the relationship between price, volume, demand, and supply by study of the graphs or charts. And there is an assumption that the share prices or the trends are repetitive. Since in technical analysis, the investor psychology or the human behavior plays a big role, plays a big part. Then we see the various assumptions of the technical analysis, that it depends upon the market price, depends upon supply and demand. For example, if the market prices are, say that the demand is more, if the market prices are less, we can say that the supply is more, as the people are selling. And these supplies and demand are governed by rational as well as irrational factors. As we have seen that some of the investors are rational, they invest in the stock market, they trade by doing a thorough research and analysis. And some investor basically, you can say, invest in the stock market simply on the basis of, you can say, tips from their friends or neighbors, or on the basis of their own gut feeling. So their act is sometimes irrational. Then we have seen that the stock prices generally move in trends, and past trends are generally repetitive. We have also discussed the various principles of the technical analysis, that is, the market discounts everything, the prices moves in trends, and the history tends to actually repeat itself. The market discount everything, it is a very important concept. I have taken example also that the future events can also be, you can say, gauged by looking at the current prices. As we have seen that, yes, the budget has been declared at 3rd of February 2020, but the declining price trend was observed from the last week of January itself, from 20 to 21st of January. The reason was that some people in the know must have been trading, they must have been known that yes, the budget may not be that good. So they start selling from 12-10 days earlier from the budget day. So the market actually considers the future events also. Now the prices moves in trends, we have seen that, and the history tends to repeat itself. Whatever trend has been observed in the past, they, in most of the times, in most of the cases, repeats itself in the future also. Then we have seen the Dow Jones theory. Okay, I'm fine. So in Dow Jones theory, the movement of the market are generally divided into three classifications. That is the primary movement, the secondary movement, and the daily fluctuations. So primary movement are generally for a long term. It is for about 1 year to 3 years. And primary movement may be an uptrend, or it may also be a downtrend. And the secondary trend are between the primary trends. It may be for a few weeks to a month or so. And the third trend is the tertiary trend or the minor trend, or you can see the daily fluctuations, the daily fluctuation in prices. For example, today the price of a particular company is 100, and next day it moves from 100 to 110. And then from third day it moves from 110 to 115. So these are the daily fluctuation can be seen from this minor trend or tertiary trend. And we also seen that the primary the movement, this consists of actually three parts. That is, first of all, the knowledgeable investor starts investing, and when the knowledgeable investor starts investing, the other investors also join the bandwagon, and they also invest heavily. So the prices goes to a new high with more and more investors and investing. And then if the investors think that yes, the prices have reached a stop, then they start selling. And then the fear psychology comes into play, the fear behavior comes into play. The investors see that yes, the people are selling the shares. The other investors also start selling, and the market prices generally then comes down. So this is the bear phase. And if most of the company recovers from this position, and if the investors think that there is very less possibility that the company may recover in future, or the company's prospects are not very good, then distress selling happens, as it was happened in the case of Yes Bank and the Lakshmi Vilas Bank. Yes Bank and Lakshmi Vilas Bank, in these two cases, the share market price has slid down drastically. This was distress selling. Now, we have also discussed the Elliott wave theory. Elliott wave theory is a, you can say, follower of the Dow Jones, but he has developed his own theory, which are very much relevant today, even after 100 years, 90 to 100 years. There are two patterns in Elliott wave theory. Impulsive patterns and corrective patterns. The impulsive patterns are those patterns which show an uptrend. So we have seen by a diagram by way of Elliott wave that there are 5 trends. One, it goes an uptrend, then down, then up, and again up. So there is a 5-wave pattern, and then there is a 3-wave corrective patterns. The basic thing to note in Elliott wave theory in simple language is that when the current high is higher than the previous high, then there is an uptrend on the basis of this uptrend. For example, if the market goes down and goes up from, for example, it goes up from rupees 50 to rupees 60, it goes down to 50 again and then moves to 70 or 80. So this 70 or 80 is actually more than this previous high of 60. So by this, the technical analysts judge that yes, the market is an uptrend, it is better to purchase the shares of a particular company. Corrective pattern shows when the, you can say, the current low is actually higher than the previous low. So the market is coming down and it is coming down at 50 to 40. It goes up from 40 to 50 and again comes down to 30. Then this 30 is actually higher than this previous low of 40. Then the technical analyst can easily see that yes, the market is on a decline and it is showing a bear trend. It is better to sell the shares. So this is the corrective pattern. Then we also see the random walk theory. The random walk theory gave their argument that the market, you can say, cannot be predicted. The future cannot be predicted because past trends are, because you can say share prices react to different news differently. So such news, reactions of such news cannot be repeated. So they gave their argument, and random walk theory is similar to the weak form of efficient market hypothesis, as we have seen. We have seen the line chart. In line chart, only the closing prices are shown. And in the bar chart, not only the closing prices, but opening prices and the highest price during the day and the lowest price during the day are also shown. For example, the market opens at 9:50 in the morning and closes at 3:30 in the afternoon. If the market, for example, opens at 100 and it reaches a high of, say, 120, reaches a low of 90, but finally settles at 150. So it shows a uptrend. So from the bar chart, you can say that yes, at what price the market opens, at what price the market closes at 3:30, and it reaches at what price, highest price was what during the particular day, and its lowest price during the particular day. So bar chart gives a good amount of information. Japanese candlesticks also show the same thing as bar chart, that is opening price, closing price, highest price during the day, lowest price during the day. All of the information are shown in the Japanese candlestick. But the Japanese candlesticks are more frequently used by the technical analysis for the simple reason that they are user friendly, and certain addition you can advantage in case of a Japanese candlestick is the doji candlestick. Doji candlestick is the candlestick in which you can easily find out that what is the closing and opening. Means closing and opening prices are same. Doji is the situation where opening and closing prices are same. It shows a tussle between the bear and the bulls. That is you cannot judge from doji that where the market is going. Then we come to the point and figure chart, in which I have also given a practical example, which is given in the study material of point and figure chart, that any uptrend is shown by X and downtrend are shown by O. And for every uptrend, X are shown, and reversal, if it is the reversal of 3 rupees, then O is placed in front of it. So this way point and figure chart is shown. Now we came to the market indicators. We discussed the market indicators. First we discussed the breadth index. Breadth index, which shows the net advances are declined by the number of shares issued. If the number of advances during a particular month, for example, in NSE Sensex during the past 1 month, out of 50 stocks, for 39 stocks, out of 50 stocks, 40 stocks have advances. Means 40 stocks shows an uptrend. And out of 50, 10 stocks have been showing a downtrend. Means the prices have been decreasing. It means the market is volatile. So breadth index shows that the market is volatile. And out of 50 stocks, if 25 are showing decline and 25 are showing up, then you can say the market is more or less stable. We have also discussed that the volume of transaction is very important in case of technical analysis. If the market is rising in case of a particular stock or there is an uptrend and volume is not increasing, means the number of people are not actually not too many people are trading in such stocks, then there is you can say a warning signal. So if the share prices are going high, the volume of transaction should be high. If the share prices are going down, the volume should be high because it indicates that the trend will continue for some more time. Then we come to the confidence index. Confidence index shows that the ratio of high grade bonds to low grade bonds. So if the ratio of high grade bonds are generally low in comparison to low grade bonds, but between the difference, if the difference between these two bonds, means high grade bonds and the low grade bonds, are lower, for example 93%, 94%, as we have seen during an example also, then you can say that the economic situation is good. For example, if the bond yield is rising, the economic situation can be considered, bond yield on high grade bonds are actually rising. Then we can say that the government is actually pumping huge amounts of money and there is enough liquidity into the system. You can say the industries or various sectors are getting funds at cheaper rates, at lower rate of interest, and this actually pushes the economy, likely to push the economy up. So this will instill confidence in the mind of the investors and they are likely to flock to the stock market. Relative strength analysis means a particular stock is moving move faster in comparison to the other stocks. As I have given the example also that in case of automobile sector, for example, last 1 month, the automobile sector is increasing at 2 to 3%. But the shares of Eicher Motors has been increased at 5%. So you can say that the Eicher Motors has relative strength in comparison to other automobile players in the market. Odd lot theory. Odd lot theory says that an average person is generally wrong. So technical analyst who is experienced enough generally acts contrary to the general investors and average investor. Support and resistance, we have seen it is a very important concept. Support is the level at which the prices will not fall below. So technical analysts generally buy at the support level, and resistance is the level at which the prices will not go, are not likely to go up. So at resistance, the people used to sell. Now we have also discussed the various price pattern and we interpreted it. There is a channel we have interpreted by your diagrams also. That is, the channel can be an uptrend as well as it can be a downtrend. We see the wedge also. The wedge is the shape of a wedge, that is a golf club or the golf stick. So wedge means there is a huge uptrend on a huge downtrend. Means the resistance goes up drastically and the support also came down drastically. Head and shoulders, we also see the inverted head and shoulders and the head and shoulders. Head and shoulders shows a bearish trend as we have seen during the assignment also. And the inverse head and shoulders show a bullish trend. Triangle and coil formation. Triangle and coil formation shows a confusion or it shows a consolidation in the market. Flat and peanuts means the previous trends are likely to continue in the future. Double top actually gives a bearish signal and the double bottom shows a bullish signal as we have seen during our examples also. Gap means gap between opening and closing. So larger the gap between opening and closing, the stronger the signal. For example, a price of a particular company, say Dabur India. So Dabur India opens at 500 at 9:15 in the morning. Okay, but in the afternoon at 3:30, it closes at rupees 550. So there is about 10% gain during a particular day. So gap between opening and closing is huge. that is 50 rupees. So what it shows a strong bullish trend. It shows a strong bullish trend means the uptrend is likely to continue for some more time. Then we come to the moving average. We have seen the arithmetic simple moving average and the exponential moving average. Basically, these are both used by the technical analyst. If the technical analysts are viewing going for a long term, then they use simple moving average. And if they are investing it or trading it for the short term, they use the exponential moving average, because exponential moving average is closer to the latest price. This is the formula of the exponential moving average, and by this formula we have calculated a practical question also. We have done a practical question also on this. There are various arguments in favor of technical analysis, that the crowd psychology works, the past trends are repeated, and fundamental information or fundamental analysis is not required. It is basically covered in the market prices itself. And there are certain arguments against the technical analysis as per the random walk theories, that the future cannot be predicted. And as more and more people are already using technical analysis, so you can see the importance of technical analysis is diminishing. So these are some of the arguments against the technical analysis. We've seen the efficient market hypothesis in detail. The weak form, the past trends cover, you can say the market actually reflects the past prices. Semi-strong, the market not only reflects the past prices but also the publicly available information. And strong form of efficiency, the market not only covers the past prices but also the publicly available information as well as the private information, which is the insider information. There are various challenges to the efficient market theory. We have seen that it is generally considered that yes, the market, the prices, you can say the information are freely publicly available. But in some of the cases, it is not so, because some companies deliberately, you can say, hide the information and they do not percolate the entire information which are required to be given to the investors. So you can say information inadequacy is a major challenge to the efficient market theory. And we have also seen that there is a limited information processing capabilities of the human beings. We have seen market behavior because some people simply do not invest in the market on the basis of any thorough research or analysis. They go by their instinctive behavior. Monopolistic influence, we have seen that the foreign portfolio investors still actually dominate the stock market. If the foreign portfolio investors actually withdraw their holdings, then the market generally tends to come down. So this is what about the technical analysis. Again, this is you can say the email ID and the phone number. And thank you so much. Thank you so much for your patient listening. And I hope you have enjoyed this session of technical analysis. So over to Ashish sir for his conclusion.
Thanks a lot, Vivek. Student, I hope the topic of technical analysis must be very much clear to you. As Vivek sir has explained the topic in a very lucid and very comprehensive manner. Students, when I was going through the queries, one or two queries has come in the examination with this diagram. We have to write the theory as well. Student, normally our past experience that there is no such questions are there. However, you can you can prepare the diagram, but you know to devote too much time on the accuracy of the diagram. You have to just give the hint. Okay, you need to draw, because in examination your time is very precious. Okay, so you have to just draw a simple diagram and just a small lines. Okay, but theory is a more important because the content is a king. And you have to see what are the key points that you need to be covered. Now, one student was saying there was some confusion regarding head and shoulder. Confusion was like that. Sir, I have confusion like whether it's a bull run or whether. See, student, here I would like to specify that whenever any technical analysis we carry out, so it is always does not mean that we have a same conclusion. Always our behavioral aspect and personal biasness will be there. For example, when two persons are doing the same technical analysis, they may have their own perception. So behavioral aspect also plays a big role. So we cannot say we will reach, both of us will be reach to the same conclusion. There may be slight differences. Okay, so we cannot like in our dividend valuation, our valuation theory, valuation models. You try the answer, I try the answer. If we are applying the same formula, we are getting the same answer. But in technical analysis, it is not like that. Okay, in technical analysis, we have to see our own judgment also. We have to apply the same. And
sir, I want to add something. Sorry to interrupt you. I want to add something, sir. That the question Harshad asked regarding head and shoulders has been clear to him. Actually, he have also reciprocated, and it has been clear to him the difference between head and shoulders and the inverted head and shoulders.
So no, I'm just giving my overview because sometimes student may say, sir, I am not clear on the technical analysis. My conclusion is not matching. That's why I'm saying.
Yes.
And student, now there is one topic has been left on your security valuation chapter, that is bond valuation. So student, actually due to some reasons, I will take up this topic, bond valuation. But however, due to some my prior occupation, I will be taking this topic on 22nd November. But from day after tomorrow, that is on Friday, we shall start the topic of portfolio management. And CA Devas Gupta is a very renowned faculty, will take up the session. So student, please join us at the same, because portfolio management topic is also very important for you, and it is one of the and it is also, as it is related to your security valuation and security analysis also, because whatever you have studied, you will see what are the other methods that you follow in the market. So student, thanks a lot for your patience listening. And as Vivek sir has shared the email ID and phone number, if you have any query, please contact us. Thanks a lot, Vivek, and thanks for your sparing precious time. Have a nice day. Student, have a nice day, you too. Thank you.
Thank you, sir. Thank you, students.
Yes.